in 1997, the Roy Morgan data was used for the Wallis inquiry, the financial inquiry. And today, the government's having another inquiry. That one will be known as the Murray Report. And the submissions that have been asked for that, and it's been asked that people focus on the kind of things that have changed in the financial system since 1997. Now, who can honestly remember? That was before Facebook. Most of us in those days happily left home without our mobile phone. How many people do that today? The 40% that actually had a mobile phone hadn't realised that their mobile phone wasn't smart because there was no such thing as a smartphone. 1997 is when 85% of Australians read hard copy newspapers, when the 30% of Australians that had the internet had dial-up, when less than 1 in 3 Australians believed that homosexual couples should be allowed to adopt children. That's now a majority. So, social issues have changed enormously as well. 46% owned their home outright, not the 34% that it is today. Only 15% had a degree. That's now well over double that. And just over a quarter of Australians were over the age of 50. About 33% of surveyable Australians, that's people aged 14 plus. The exchange rate was 60 cents to the American dollar, and 64% of men worked and only 48% of women worked. Now, of course, a majority of women, about 53%, are employed. So even 1997, the last financial inquiry, was a really, really different time. Most of us have some kind of marker that helps us think about what 1997 was like. We can generally link it to something that happened in our lives, but we don't have any real sense. We're just unable to remember or have the data to help us really map out what it was like. Into Roy Morgan research, of course, because we track this stuff. But what we all know, it was before we saw The Wolf of Wall Street. So seriously, there's been, I guess, extraordinary changes in people, in attitudes, in financial products that are available, and that's come about through a whole range of things. Basic things that we look at in terms of the state of the nation normally. An ageing population, changes in education, the women's movement, major changes through technology, and of course the role of finance is both, driving that and driven by that. Finance and the role of finance in our lives is inextricably intertwined with all of these other social issues. So today what I'd like to do is to actually look through some of the core data about the financial services industry. And before I begin, I'd like to thank all of the people at Roy Morgan Research that collect this data, analyse this data, put it together, and the most important thing, make sense of it. Because you may not know, it's really easy to do a survey of attitudes. It's the easiest thing in the world. Anyone can get SurveyMonkey, anyone can do a survey of attitudes. You don't know if it's right or wrong, but it kind of gives you a clue. It's a very forgiving business doing attitude surveys. It's a very unforgiving business when you're trying to survey people, ask them about their financial behaviour, what they own, what they're intending to do, about these detailed financial products and situations, and then actually put it to the test. Test it against the known figures that exist from the Reserve Bank of Australia or APRA or wherever the numbers come from. That is a really tough gig. And, the people in our place, I know, go insane making sure the numbers gel, but we make sure that the overall estimates that come from the survey map onto the known facts, and that then enables us to start drilling down. Because the Reserve Bank will know about total dollars in investments, perhaps, but they won't know where they come from. They won't know which people. They won't know which state. They're unable to drill any further. So at Roy Morgan, we go through this, quite gruelling process to pull together the data, surveying people, analysing it, and putting it together to be able to present for you and for everyone else to have a handle on some of these really important core changes that are happening. The most dramatic change that's happened in the consumer financial services market since 1997 is the sheer growth that we've actually seen. If you look at the Australian population, we've gone from something like 14.8 million in 1997 to 19 million in 2013. That's an increase of just under 30%, 867 billion, and it's now 3.4 trillion. an increase of just on 300%. So an increase that's 10 times the rate of population growth. All that money moving around in the financial services market. So what we mean by that market, we're talking about, basically deposit type accounts, we're talking about loans, and we're talking about superannuation. We're not including in these numbers at this point things like direct investments, and we're not including the value of people's homes. So you can actually see just the sheer growth is the big story, I suppose, that we think about. And the major driver is the growth in superannuation, and you can see that extraordinary growth from 245 billion up to 1.8 trillion. And for those of you who know about these things, the GDP is about 1.56 trillion. So these are big numbers. Some of you are very financially savvy and you live in the finance world. Others, like most of us, actually dip in and out. So it's really important to realise these are actually huge, extraordinary numbers. And clearly the superannuation now represents a huge proportion of this financial services market. So that superannuation, that growth of 368 to that 1.8 trillion represents just under half of that whole financial services market. So this is kind of raising the issue, a really big issue, about the future of the financial services market, about the future of superannuation. There are questions about whether 9% enforced super should go to 12 and whether that's the right thing to do. This is a kind of enforced saving. It has an impact on people. It comes out of people's pockets or the employer's pocket, depending on whose view you take and how people's packages are created. It comes out of the taxation system, and it's money that's sitting there either doing wise things or doing less than wise things. And that's obviously going to be one of the big issues. The other big growth area that you can see from here is loans. And loans have actually gone up quite substantially. The numbers here in terms of loans up from 400 billion to 1 trillion, so that 324%. Now this is likely to come under review as a question about whether households have actually overextended themselves in this whole borrowing market. And the large chunk of that obviously comes from home loans. And our data suggests that if you look at this chart here, this is a chart of mortgage stress, or the proportion of the mortgage holders that are at risk and at serious risk. So at the moment, with interest rates at about sort of just under 6% or around 6%, we see 17% of people with a mortgage are at risk, and that's basically calculated as a percentage of their income being paid in their mortgage. And it's kind of a little bit complicated because if you have a very small income, you can't afford to have a huge proportion of your income going out in mortgage. So that's all taken care of. But 17% today at risk, and about 9%, 8.7%, are at serious risk. Now, if we do the analysis and look at what happens with particularly increases in interest rates, if we see an increase of, if we see an increase to 7.25%, we see 20% of mortgage holders will be at risk. So it's not a direct correlation, but you can see that interest rates create this quite dramatic change. And we definitely see it in things like consumer confidence. When you actually see an increase in interest rates, consumer confidence generally goes down a little bit, but it really dives among people who have mortgages. So there's a very direct correlation. And of course, if interest rates went to somewhere between 9 and 9.5%, we'd see the kind of at-risk situation that we saw in 2008. You'd be heading up for 27% of mortgage holders at risk. So obviously, this is another question that will be being asked around loans, because we've seen the substantial growth in loans. Now, most of the analysis that we'll look at today focuses on that financial services piece that doesn't include direct investments. And there's no magic in this. It's probably the area that the Financial Services Inquiry will actually focus on, rather than direct investments or people's own home. But just so that you get a sense of it, if you include direct investments, you add another chunk, about as big as the loans area. And that's also increasing, as is the actual value of people's homes. We have 250 billion for shares, direct shares, and 657 billion in real estate. One of the major drivers of the growth in superannuation has been the growth in self-managed superannuation funds, and we've actually got now about 500 billion currently in self-managed funds, and that's a growth of just under three times since 2004, compared to an overall growth in super of about 100% in that latest time. Now, that was never anticipated. All the thoughts about superannuation were actually preparation for retirement, all of those kinds of things. It was anticipated that they would be managed by big funds. It would be a sort of serious, well-managed, well-orchestrated place that people's money was kept. And in fact, what we're seeing is this substantial growth in self-managed super funds, because people are actually deciding, those people who are able to are deciding that they'll actually put their super in somewhere that they're in fact able to manage themselves. They're taking charge of their own destiny. And in general, people who are managing their own super fund claim to be more satisfied than those people who have their super funds managed by somebody else. The growth in super funds is coming from two directions. One, the sheer amount of money, because investments have actually increased, and the other one is the increase in the number of people that have got super funds. So that you can see here in 1997, about just on 50% of people had super. Now it's at over 70%. So more people having more dollars in super. On the other hand, the other area that we saw with growth, home loans, is coming more from people having more money on their loan, borrowing more money, going into more debt. The actual change in the number of people having home loans is not that great, or having loans at all is not that great. Now, one of the next things that we look at, which is kind of important, is the increase in, just looking at this by age group, the increase in the dominance of the people aged 50 plus. So we've heard lots and lots of things about the baby boomers being the biggest group of people, the growing group of people, where all the dollars are. And what we're seeing here is that the 50 plus people are in fact increasing their dominance in this area. So we've got here the proportion of dollars, that's these two slides, and we've got the proportion of population over here. So in really simple terms, the number of people who are in that 50 to 65 plus group here has gone from about 33 to about 40% there in people. But in terms of dollars, it's actually, I should be doing these sums on the fly, shouldn't I? In terms of dollars, it actually represents now 56% of market value. So up from about 40% of market value here. So the 50 plus market, which is a substantial proportion of the population, represents clearly the majority of dollars in this whole financial market. The other important way to look at this is in terms of general spread of dollars. Now we're looking here, we create these quintiles, which is just breaking things up into 20%, based on the dollar value that people have in these financial services. And it's really important to realise when you look at this that you don't actually take your assets minus your loans. It's not a net thing, it's actually assets are one thing plus loans, because all of those things are financial services. So you don't necessarily find all the wealthy people in the top quintile doing most of it. You can get into the top quintile because you have lots of money in your super fund, or you can get into the top quintile because you have a huge amount of debt, or a bit of both. But if we look at this, we actually see that in order to be in the top quintile, the top 20%, you'll have something like $414,000 or more in financial services. If you're in the bottom quintile, you'll have less than $8,000 in any kind of financial services. So there's this quite extreme in the population, and you can actually see that there's a really significant skew, as there always is. It's not quite the 80-20 rule, but you've actually got 65% of the value is in that top quintile. And the two bottom quintiles, the lowest, the 40% there, represents only about 2% of the value. So really, really extreme. So you've got one quintile at the top that's got a lot of money sloshing around, a lot of issues, a lot of complexity, and there's a range of things that need to be considered. And then you've got the access issues at the bottom, where you've got 40% of the population with only about 2% of engagement in the whole market. If we try and understand these people, as I mentioned, they're not just the rich people who are in the top quintile and the poor people who are in the bottom quintile. Obviously, the poor people tend to be in the bottom quintile, but it doesn't always work out so clearly. What we find, and we look at this through our new way of looking at the market helix personas, which takes into account, it's a very geographically based thing, but it's looking at people in terms of their socioeconomic status, their values, their attitudes, their affluence, a whole range of things that sort of roll up and help us understand people. So we can see clearly the people at the highest quintile are what we call blue chip, which is exactly what you'd expect it to be. Self-made lifestylers, status matters. And these people, for instance, are people who've got massive mortgages, double incomes, massive mortgages, so a lot of engagement in the financial services market. Not necessarily people that have always played shares all their life, not necessarily incredibly financially savvy. And here's where you'll find them. You can actually look at where they would live in a place like Melbourne. And then if you look at the bottom end, you've got the people who are least likely to be engaged in any of the financial services, are people that we call struggle street, new beginnings, doing it tough, the coupon clippers, aspiring immigrants, people who are right at the bottom struggling end of society. Plus you've also got social academic, the youngsters who haven't yet begun to engage in the market. So those people sort of blur together unless you can pull them apart with some kind of understanding about where the big engagement is and where the access issues are. It's a very strange mixture across society. It's not as simple as you would think if you didn't have any data. So those people are living, these most least likely to be engaging in anything to do with this financial market are in the sort of outer suburbs. So you'll see things like the Dandenongs, you'll see things like out towards Taylor's Lakes and St Albans and those sorts of things. Here's the Sydney market. You'd see the top end of the market and you see the bottom end of the market. If you look at Queensland, you see the top end of the market, most engagement, and least engagement. So we have where this stuff is all having an impact. Now the next thing, one of the key things that was obvious from the beginning is what has technology done to change the whole system? Clearly, technology has changed to an extraordinary degree the channels that financial institutions use and the channels that we use to get our financial information. So in 1997, you had about 62% of people were using branches and, nobody was using the internet. 0.4%. Internet banking was just, tiny, tiny, tiny. Now we've actually seen that internet banking is used by 58% of people in an average 4-week period, so it's ahead of branch banking. There's been this incredible shift in the way that people actually access information. And the most recent innovation is mobile banking using an app. And that's 1 in 4, more than 1 in 4 people are actually doing their banking over a mobile phone app. This is dramatic. And it's not just kind of dramatic in terms of how interesting is that. It just has huge implications. It has huge implications for the degree of understanding that people have, the engagement that they might have with the banks or anybody providing financial services. It has a huge implication for the cost of providing services to people because banks at the moment are having to cover off branches, telephone banking, online banking, now mobile banking. So all of their resources, their communication channels are actually stretched. And, it's fairly obvious which direction it's going. It's all very much going less touch to sort of high tech. And clearly that's just great for some people and it raises issues for other people. So very simply, it's really easy to understand. Not everyone takes up technology at the same rate. So anyone who's an early adopter, that means you love technology, into technology, got the money to spend on anything to do with technology and feel really confident to do it. you'll be doing all this stuff and just happy as Larry. On the other hand, if you're a laggard or terrified of technology, you will find your ability to engage with the financial services market being reduced before your very eyes. And no surprises we actually find in terms of age groups. If we forget the really youngsters, the 14 to 24, because to some extent they're just engaging less, as we saw with banking anyway, really it's a pretty clear pattern. Anything to do with these new channels, internet, using a website or an app, it's basically the 25 to 34. The younger people are more likely to be doing it. The older people are doing it, but less so. So there's definitely an age factor in there. There's lots of factors, obviously, but age is an important one because age relates to some of the issues around super, around the complexity of the products that people have to engage with these days to manage their own retirement. So it becomes quite an important issue. This is looking at these quintiles. Remember, we introduced the notion of quintiles, which are the people at the top end who have lots of engagement and lots of dollars in the financial services industry, and the people at the bottom end who really don't have too many dollars. And what we're seeing really clearly here, if we look at the internet banking, using websites, for instance, it's the people in the highest quintile that are engaging most online. When it comes to the app, it's not quite so clear, and this will be driven by the youngsters in here at the lower quintiles engaging with apps. But that will definitely go the same direction. So what we're seeing is kind of a coalescing of younger people engaging with technology, and we're seeing more people able to deal with more complexity and engaging with more complexity, dealing online. And we've got the people who are not dealing with complexity, older people that are not using these online technologies nearly as much. One of the big issues for the last 1997 inquiry was about competition, and it was anticipated that competition would increase, and that was a fairly reasonable conclusion. We thought we'd have banks coming in from overseas, we thought we'd have a whole range of other players engaging in this financial services market, and yet what we actually see is we see that today the major banks have 85% of customers, 85% of Australians deal with major banks. And at the time of the financial inquiry, it was 79%. So in fact, on a really simple measure, and there's no question when it comes to the financial inquiry and the submissions, there will be many submissions that define, ownership of the market. Everyone can look at this in a different way. And, it'll be which market, is it customers, is it dollars, is it the banking system, is it this, is it that? And it sort of reminds me of the first legal case I was ever involved in. It was with Arnott's and the biscuit market. And as the expert witness, I had to argue there was no biscuit market, it was a snack food market. So, Arnott's didn't have a big share of the snack food market, even though they had a big share of the biscuit market. And I see quite a lot of this in this analysis. We look at the banking system and the broader financial system. But still, on the very simple measure, we see that at the time of the last inquiry, we had 79% of people dealing with the big banks, and then it was sort of trending fairly stable down a little bit. And what we had then was acquisition by some of the major banks, of minor banks, to increase their market share or increase their penetration within the Australian population. So Westpac acquiring St George and CBA acquiring Bankwest. So that's at the top end. At the bottom end, obviously, what this has done is created fewer second-tier banks and therefore a smaller share for the second-tier banks. And also, we're seeing building societies and credit unions trending down in terms of penetration. And that's really not so much that they're losing customers, but they're actually moving in to become mutual banks. So the shape of the market has actually changed to an extent that we now have much more engagement with people with the major banks and much less with these alternative providers. So we now look at the dollar value. So that was the number of people, 85% of people deal with the major banks. If we look at the dollar value, we see some interesting points. So we've got here total financial services, that's like the snack food market, and we've got traditional banking products, that's the biscuit market. So banking products, obviously banks have a bigger share. But wherever we look, you see that the share of dollars has increased In 1997, the Big Four had 52% of dollars in the banking market. They now have just on 73% of dollars in the banking market. If we take the total financial services market, including super, you actually see that the figures are generally lower, and that's because the banks aren't so strong in the whole super area, but they've gone from 30% up to 44%. So on that measure as well, the Big Four have actually increased their strength. And essentially what we've got here is 1997 and 2013, so grey's 1997, red's 2013, and across every product, the Big Four have increased their share. So what we've got is we look at, say, traditional banking. So we've got in 1997, 52% of traditional banking was with the Big Four. Now it's 72%. If we look at accounts, the major four banks have gone from 57 to 72%. Loans, they've gone from 48% to 73%. Home loans from 49 or 50% to 74%. Credit cards, 72 to 77. And even super, which is the only one of these financial products that people don't have, that the banks don't have a major share of, even in the super area, it's actually increased from 7 to 18. So that's what we're seeing really in financial services and competition. Just briefly looking at insurance, the insurance market is really quite different, and I suppose the real issue in insurance is not so much to do with banks, and I don't know to what extent this will be a big issue for the financial inquiry, but it's more about the market dominance in the insurance market of Suncorp and IAG, and they together hold 60% of the market between them. In the general insurance, which is this one here, you've got the banks with a very small share. In risk and life insurance, the banks have grown a larger share, but it's still around 30%, so it's not a major strength. And this is really the biggest competitor to these major banks is the AMP, which took over AXA during that period. Now, there's a couple of other things that we look at in terms of, I guess, what banks are trying to do, what we need to worry about in terms of understanding the financial market, what customers are doing. And they're things like, do customers deal with more or less institutions these days? Do they have more or less financial products these days? So the banks call it loyalty, and so if a customer of yours is dealing with 5 institutions and you're one of them, there's not a great deal of loyalty is the general view. If you're one of 2, you're in a better position. So what banks tend not to be able to look at so easily, but we do through this data, is just how many financial institutions are people dealing with. And if we look at banking, traditional banking products, not much has changed. People in 1997 were dealing with 1.7, just less than 2, financial institutions for their traditional banking products, 1.66. So very little change there. But if anything, it's trending down. It's this other area when you look at all financial products that you see people dealing with 2.96, just on 3 financial institutions in 1997 and just on 4 financial institutions in now, to the end of 2013. I think the area that is age, obviously across all age groups this is happening. I think the only surprising thing really is that this 50 plus, the 50 to 64, the baby boomer bunch, the number of institutions that they deal with is still increasing. So the pattern's changed. It was like once you hit 50, in 1997, once you hit 50, you stop dealing with so many institutions. These days, you continue to increase the number of institutions that you're dealing with to a later age. We now look at the number of products held, and I think this is where we're actually seeing some changes going on. So if we look at traditional banking products, just under 3 products was the average in 1997. Now 3.75, just under 4 products per person. So we have a slight increase in banking products. But then when we look at all financial products, we actually see, just about 7 products in 1997 and over 8 products in 2013. So this, 2 things come to mind. One is there's an increase in products, but 2, there's quite a lot of products that people are actually dealing with. And if we look at the age breakdown, we see that at the age of about 50 to 64, well, first of all, there's more products being used across every age group. There's nothing that stands out there. But at the age of 50 to 64, people can be dealing with more than 10 financial products on average. So you've actually got quite a lot of people dealing with 15, 19 financial products. This is quite a lot of stuff to be actually dealing with and thinking about. The other thing that is of great interest, and the banks use this as a real measure of their ability to, I guess, engage with their customers, and that's about cross-selling. Are they cross-selling? Are they able to get more of a customer's total share of their wallet? And it's measured either in dollars, so that's when it's called share of wallet, or it's measured in terms of share of products. You know, if you have 6 products and 3 with the bank, that would be 50%. So the average of the big 4, when the first Wallis inquiry was being held, an average big 4 bank had 26% of its customers' wallet. So they'd actually look at it and go, of all the dollars that my customers got, I've got 26% share. Now that's up to 32%. So the big banks are gaining in this amount of individual customers' wallet or total money that they have, and a very similar picture in terms of share of products. So on these measures, the big 4 are actually gaining quite a degree of traction with their customers. When we look at the traditional banking products, that's the whole financial system. So that's the whole big picture. When we zoom in and we look just at the financial banking sort of products, what you see is the share of wallet was less than half in 1997. So an average big 4 bank would have an average 44% of its customers' wallet. Now it's to 53%. Big gain, and it's a majority. And when it comes to share of product, similar picture, 49% to 53%. So again, it's the same sort of gain. Then we look at the main financial institution. And this is pretty simply, we ask people, which is your main financial institution? We don't look at all of their finances and make a decision that they've got their biggest amount in a loan, so that's their main financial institution. This is the bank or financial institution that they consider to be their main one. And we see that in 1997, the big 4 were seen to have, people considered them to be the main financial institution for them in 63% of cases, 63% of the time. It's now 68% of the time people will actually say that one of the big 4 is their main financial institution. Now, against this backdrop, one of the really good things that's happened, and it's obviously absolutely critical, is that the banks have focused very much on customer satisfaction, and they've achieved great strides, great inroads. So here is, this is the major 4 banks, just a broad picture of their customer satisfaction. And what we see in 97, that's about here, a couple of things. Overall customer satisfaction for the main 4 banks was kind of between 60 to 65. That's one thing. Secondly, it was trending down. So the Wallis inquiry was held in an environment where people were increasingly dissatisfied with their banks. That was the kind of environment. So what we saw is even after the inquiry, until about 2000, satisfaction with banks continued to dive. There seemed to be a big focus on cost cutting. There were a lot of issues going on for banks where they were actually just trying to manage their ways through sort of operational and practical issues, and particularly cost cutting. And then around about this time, we saw that the banks, you know, individually and en masse started to think and talk customer satisfaction. We saw some of the major banks totally re-engineering their sort of backroom systems so that they could provide better customer service. We saw a focus in the banks. If you've been talking to a bank in 1997, as I was, they didn't have customers, they had accounts. They didn't want to talk about customers. You couldn't sell them data about customers. They didn't have customers. They had accounts. And then by this time, it was pretty clear banks had customers, they were thinking about customers, they were linking together all of the different products that people had and treating people as a one person and focusing like crazy on customer satisfaction. So we've seen now this, there's a race on to be the bank that has the greatest customer satisfaction. And today it's the CBA, that yellow line is right at the top. But overall, it's driven an improvement in the way that people view banks in terms of their customer satisfaction with their bank. I mean, I think bank bashing is probably about the same level that it's always been if you were to just kind of listen. But when it comes to how satisfied you are with your bank and your relationship, that's definitely gone up. So that just provides a different context, another context for the financial inquiry. When it comes, though, to business banking, you find they're not nearly as satisfied. So the average satisfaction level for businesses, when we ask them about their banks, is around about 65. And there's not a lot of, it's a little bit better than it was down here, but basically there's not a lot of improvement going on in that whole space. And when we get people to rate, when we get businesses to give us their views of the banks, they rate them quite well on being friendly and courteous and knowledgeable. So they don't dislike their bank manager. That's not the problem. The problem is the areas that they rate them poorly, and that's things like following developments in the business, understanding their business, actually having a good understanding of the industry. So those are the real weaknesses for business banking. And it's pretty important because if we're dealing in an environment with increasing complexity, and the money's being taken into super funds rather than being able to fund smaller stocks and things like that, you can see that the banking system, the banking relationship is incredibly important to business, and particularly a real stress is the small businesses who have complex needs but they don't have the resources to manage them. So this is where strongly you'll find they don't understand my business, can't just come in with a product that works for me or solve my problem. So while customer satisfaction's moved to an extraordinary degree among consumers and ordinary people, from a business perspective, it still has quite a long way to go. Just briefly, and I won't labour this too much because in a way it's just proving that satisfaction matters, but really briefly, what you find satisfaction matters in terms of intention to switch. Across the board, if somebody's very dissatisfied with any bank, they're much more likely to switch to another bank. That's what they tell us. What we find also is that if you're very satisfied, you're likely to deal with fewer institutions. You're more likely to happily have your business with one or a smaller number of financial institutions. You'll spread it around if you're dissatisfied. It's interesting because the banks are working really hard, I suppose, to be able to maintain this position, to be good corporate citizens so that they can be allowed to continue. I mean, clearly, if the customer satisfaction had continued to tank, everyone would have been frustrated with the banks. It would have been a very, very different situation going into a financial inquiry if everyone was really dissatisfied. Banks weren't doing a good job, but they had this lion's share of the business. The point that these slides are making is that customer satisfaction is not just something that you do as a PR exercise. The banks are actually finding that the key things internally that they focus on are driven by satisfaction. So internally, when it comes to customers, they're looking to say, can we hang on to our customers? We don't want to lose them, unless they're very particular customers that you just don't want. But generally, banks want to hold on to their customers. If they're satisfied, they're less likely to do that. These are people who are, the proportion of people who are very satisfied, or the people who are very satisfied, how many institutions do they deal with? 4. So in this case, you've got 4 institutions. Those people who are dissatisfied, 4.5 institutions. When it comes to CommBank... Sorry? Yep. Lesson in slides. But in generally, all it's saying is if you're satisfied, you will deal with fewer institutions. If you're dissatisfied, you're likely to be dealing with more institutions. A similar slide, very satisfied, very dissatisfied. If you're dissatisfied, you will be more likely to put less of your dollars with the bank. If you're satisfied, you'll be more likely to have a larger share of your dollars with that bank across the board. So we see in each case the very satisfied column is higher, greater share of wallet, than the very dissatisfied, lower share of wallet. Now this is where the interest comes. So what we're finding here is those people in the high quintile, those people who have lots of engagement with financial services, lots of products, lots of dollars in their financial services area, that's across this side, for every bank, are less satisfied. So people who have simple needs, more likely to be satisfied. People who have complex needs, complex engagement, lots of dollars, less satisfied. That's a pretty important finding for the banks. If it's pretty easy to satisfy some people if all you're doing is perhaps putting in, an unemployment check, or if all you're doing is dealing with something simple as a student, you need a credit card, whatever. It's hard to get that wrong. It's when you're actually doing complex borrowing, there's large amounts of money, you're trying to judge, can I borrow some more? Should I be putting it in another financial institution? Is there a different instrument I could use? That's when it becomes complex. That's when you can find that you're not comfortable with the decisions that are being suggested to you. Anyway, that's where people are, the data shows, less satisfied. Customer switching, just in really simple terms, let's get out of that big detailed stuff on customer satisfaction. What we found in 1997, last time the inquiry was being held, you had just under 4% of people saying they intended to switch their main financial institution. These days, it's around about 2%. So fewer people these days planning to switch. Makes sense? They're more satisfied. There's more of their wallet engaged with that one financial institution, probably therefore harder to disentangle it. But banks are more sticky. That's what that's basically saying. So in overview, I think what we're seeing is the financial system has grown. That's the really, really big piece. When we ask people what's the most important issue facing Australia, everything to do with the economy is the biggest issue. So the economy at 39% is the same as every other issue that pops up, whether it's to do with terrorism, war, social issues, the environmental issue, add them all up and they still only come out the same as the economy. Today, Australians are focused on things economic, and that's to do with finance. That's to do with unemployment and concerns about unemployment. It's to do with taxation. It's to do with the way the country's going economically. But we're looking at things through an economic lens. Consumer confidence is okay. Consumer confidence is tracking at about 114.5, up a little, and well over that 100%. Business confidence looks okay, 131, being held up still by the mining sector, but that's down 14 points. So business confidence is on a slide. Unemployment, the Roy Morgan unemployment estimate, 12.3%. Anyone can ask questions about that, but if you've ever been before, you'll know that the Roy Morgan unemployment figure is the right one. It just simply asks people, are you employed, full or part-time, or looking for work? If you're looking for work, we count you as unemployed. We have 12.3% of the workforce are unemployed and looking for work, and a further 8.5% underemployed. They've got a part-time job, but they'd really like to be working full-time. Well over 20% of the population unemployed, or of the workforce unemployed or underemployed, in this environment of concern about things economic. Massive amount of money in our superannuation assets. So that's one of the key things. We keep hearing we're underfunded for our retirement. We've seen that there are real pockets of pain. There are areas where people have a lot of engagement with financial services and none. We saw 40% of people have less than $8,000, either positive or negative in any kind of financial system. They're kind of out of it. There's real extremes. These large amounts of dollars tied up in super funds has quite a lot of issues, doesn't it? It raises issues about adequacy, not only adequacy of whether it's enough for our superannuation, for our retirement, but is it adequate? Do we need to take it to that 12%? Is it adequately managed? Is it sort of well enough managed? Is there a level of competence needed to manage these huge amounts of dollars? And what about that 500 billion that's in self-managed super funds? Is that adequately managed? Is that really a good idea? And where does the responsibility lie? These are all really important questions. And I think there's questions about not only where does the responsibility lie, but in a broader sense, what is that money best used for? As I mentioned before, you've actually got money that's come out of people's pockets. You know, they either could have got it as their salary, it's gone into super, or, as many people would see, just the employer has to pay extra. If the super goes up to 12%, in many instances, the employer will simply have to fork out another 3%. So money's coming out of businesses to go into this area. Money's not going into the tax pool at the same rate because of that. So this money's been extracted from the whole system. Should we be thinking about that money being used for infrastructure? Should that money be directed for things for Australia? Or should it be focused completely on the individuals who are actually the ones who are going to be the beneficiaries of it? And if it is, who's to say what should happen to it? We've created a really interesting pool, not really a future fund, a bit like a superannuation future fund, and there are real questions about whether it's being handled well. There are obviously issues around financial literacy, and it's not just the people at the bottom end. There are many, many people who feel they know it, they know all the words, but do they really know? Are they really adequately able to deal with the complex structures that are being put in place? So that will increasingly be a big issue. And obviously the access issue is one that's becoming clearer and clearer. So when you actually see older people, poorer people who haven't been able to get access into this pool of funds being excluded not only financially but in terms of technology and in terms of access because of the information that they have, you have a big balloon of access issues emerging. And against this background, I suppose we actually have, who do we trust? The government today would not be re-elected. So clearly, if we ask people who they're going to vote for, there are more people that would vote for Labor than Liberal. So we're not actually saying that it's okay, the government will look after everything. We don't have that view at all. And who else do we trust? This is our question that we ask people about who do you rank highly for honesty and ethics, but it's fundamentally a trust issue. And what do we see? Maybe it's all up to the accountants. Maybe that's as simple as it is. 43% of people trust or value highly accountants. 36% bank managers. So bank managers have come from really high levels in the early days, in the 80s. They were way up there, 60%. It's been even higher than that. But now a third of people trust their bank manager. Financial planners, 1 in 4 rank financial planners highly for honesty and ethics. That's a really big important thing, isn't it? Because our super funds basically, if we don't do it ourselves, have to go through some financial planner. It's kind of decreed that that will happen, and yet we don't have confidence in their honesty and ethics. Stockbrokers are even below there, as are insurance brokers. So I think this raises some really important issues of trust for us about the whole area. So my last slide says discover your edge in amongst all of that rabble. But, you know, in summary, a growing industry, big growth, a growing industry in the financial services market, a very different environment than the one that the first inquiry was held in every different way. And I think what I've been able to do today is almost like a big data dump to say the information is here to understand the kind of issues that you think are important to your industry. Every one of our industries has different issues, and the data is here that will help us understand those from a financial perspective to perhaps put a submission to the inquiry.